Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of Lazy Boy Incorporated. So let's just get started. Now, Lazy Boy is basically a furniture and home appliances company. That's what they do. In their About Us page, the first thing you see is about their new sustainability efforts. So that's very interesting that you see that before you see anything about the company or about what they do, why they do it, their mission. But yeah, that's essentially what they're up to. Now, we're going to just jump straight into financials, right? Recently, Lazy Boy has been an interesting company, so we're going to look as to why. Now, recently, their shares have gone up. In 2022, you can see this gigantic jump, right, from compared to even 2019 pre pandemic levels. And in 2023, you can see a slight decrease. So it's interesting that it's been happening that way. But let's look at the margin level. The margins seem to have been holding steady, maybe increasing a little bit. Okay, very interesting. Let's take a look deeper into it, right? Now, if we look at their sales all the way from the end of fiscal year 21, which ends in March for them, and all the way till the end of fiscal year 23 for them, which includes all the way from May 2023 or 2022 essentially all the way till April 2023, we look at this picture of overall sales increasing and overall operating income increasing as well with it, although the margins are here and there. Net income is also there. It's not improving significantly, at least not relative to the year before, but the margins are important. This is something we'll have to take a look at, right? Now, if we look at their balance sheet, we also can compare their assets to their liabilities, right? So their current assets, we have cash and cash equivalents. They actually have quite a fair bit of cash, $343 million, right? Compared to a total, for example, of goodwill of $205 million. Goodwill is essentially something that they'll eventually have to pay, right? Eventually it'll take a hit to their net income because it's how much you overpaid for acquisitions that you've made. It's actually kind of a sleazy item in accounting. And you also have a bunch of other stuff here that leads to a pretty huge amount of assets. But liquid stuff, right? Current assets, you have $854 million compared to current liabilities, which is $475 million, and some longer term liabilities that add up to pretty much as many current assets as they have. So the balance sheet overall is healthy, right? They can pay for all their current liabilities and then some, thankfully. Although this inventories item is always a little tricky, right? And the fact is, they have a lot of inventories, but when you get rid of extra inventory, you're going to get rid of it at a discount, right? It's not going to be the most current item or the most desired item if you have extra of it just sitting there. So you may just have to get rid of it at whatever price, right? So this is a little bit of a deceiving number, but still, it won't destroy the amount of current assets they have, especially relative to current liabilities, of course. Now, what I'm going to do is I'm going to look at this revenue number that we were looking at before, which starts at 2.35 billion, and I'm going to see what analysts are predicting. You can go to Yahoo Finance, look up Lazy Boy, go to the analysis tab, and there you can see the predictions for revenue. The reason I'm doing predictions for revenue is because they end up being pretty accurate at the end of the day. And if you see here, there are three analysts here. The low and the high and the average estimate are all pretty packed together for 2024 and 2025. So I'm just going to take the low estimate just to be conservative, just to have a little margin for error here. And what I'm going to do is I'm going to look at the average free cash flow or the average amount of revenue that has turned to free cash flow at the end of the day for Lazy Boy. That is about 6.8%. So I'm just going to say, okay, we're going to get 6.8% of this as the actual cash money that Lazy Boy has at the end of every year, right? So what I'm going to do here is I'm going to plug in those numbers and then get 6.8% of that, and then I'm going to grow it by just 2% in perpetuity, okay? So with a required rate of return of 11%, right? That's 1% more per year than the market in theory would give me, right? And over time it adds up to be a lot. And with a perpetual growth rate of 2%, I get a fair value of the equity after dividing by the total amount of shares of $35.93. However, we need to account for the net debt, and they do have a little bit. So their net debt being 132 million, gives us an actual fair value post everything of $32.82 with net debt included with these numbers, right? So let's look at Lazy Boy stock right now. Interesting. So we see right now that $35.99 as of the close on December 7th. Well, that's actually really close to this $35.93 I got before including the net debt. So according to this calculation, right, with this amount of free cash flow margin, this amount of growth specifically, which actually is a decline in revenues, but not necessarily a decline in free cash flow, I am looking at a stock that's roughly fairly valued, if not a little bit overvalued after accounting for debt. However, it was technically undervalued relative to my calculation as recently as November 10th. That is because Lazy Boy did slightly better than expected in earnings. To be honest, this is kind of noise, right? I don't look at any individual quarterly earnings, I look at the whole picture. And it seems that even though revenue and income went down, that analysts were expecting it to go down by more. So then you see this last little peak here, right? Overall, though, Lazy Boy seems to have done okay in the short term, but in the long term, well, depending on when you bought, you may be very happy or you may not be happy at all. You could have bought here in the peaks of 2021 and not been happy at all. You could have bought down in 2020 when the stock was in the gutter and been very, very happy, right? What the stock does give you is a nice little dividend yield. It has a P/E ratio that is less than 15, which is usually what they use as a benchmark for the markets, right? 15 is like normal or status quo. If it's less, it's interesting to look at, right? So, what's propping up the stock price? I think this is the most important part of the conversation here, right? And in their annual report, they have a little graph of capital allocation, business investments, and returns to shareholders. And if you look at that, they spent a ton of money in 2022 repurchasing shares. They spend quite a bit of money giving you a dividend. They actually have grown their dividend by quite a bit over the last 5 years. And they have also done some acquisitions and, of course, some capital expenditures. So that's very important. Look at these huge acquisitions that they did in 2019, in 2022, and 2023 to a lesser extent, right? Look at this huge amount of share repurchases in 2022 that did not happen in 2023, right? So what we're looking at here is a little bit of cyclicality, right? In tougher times like 2020 and 21, they do not give back as much money to shareholders, right? In easier times, 2019, 2022, they do give back more, right? In 2023, interest rates are up. The global economy, or especially in the US where they're based, isn't maybe as booming or as great. The US economy is actually in numerical terms doing good, but maybe consumers just aren't buying as much as they were in 2022 and 2021, propped up by stimulus money, right? So all of a sudden the world's drying up a little bit, and so is their shareholder returns, right? Or what they're trying to return to shareholders specifically. So I have to ask myself, the reinvestment into the business is good to see, but how does this picture change in a bad year, right? What about a really, really bad year? Will you all of a sudden see them stop a dividend, stop them from repurchasing shares, etc.? So cyclicality and inventories will be key to analyze here, right? Because it'll actually affect their bottom line quite a bit. And at the end of the day, the top and the bottom line aren't growing stellarly, right? We saw that at the end of the day, these analysts were thinking that it was going to decrease relative to previous years, right? From 2.35 billion to about 2.1 billion. So that's a significant decrease, actually. That's about 10%. So it's important to note these kinds of things, right? It's very important to see this and say, okay, they aren't growing their top and bottom line. So what will keep the levels of cash that they have available in the same rate? That would be the margins, right? So margins are going to be key, right? They'll have to improve those margins, and that will keep shareholder returns going. Can they do that? I don't know. That's the thing. I don't know. But I can tell you one thing, right? We know it was fairly valued, or it was technically undervalued before. Now it seems to be close to fairly valued, right? Close to the model I have here, as I said. So actually, what's happening here is that risk and price are actually inverse, right? You're taking a little bit less of a risk investing in Lazy Boy at, for example, $25 than you are at $35, right? At $35, it is less likely that they can keep up the numbers that they've been doing and keep up the amount of share repurchases, etc. Well, at $25, right, it seems like each share repurchase will go further, right? If they repurchase a bunch of shares, they can repurchase more for less, right? And at the same time, it's more likely, right, that the stock will be undervalued the lower it is, so you're taking less risk buying the stock lower, right? So actually, this is a great example of a stock that just did great in terms of financial results, and that actually makes it a more risky investment. So what I want to say is basically here, risk is inverse to price, and you're actually taking more risk the higher the price has gone. Now, I hope this analysis was useful. It's a little bit of a different style than my usual analyses, so please tell me if you liked it, if you want to see more like this, and with that said, please like and subscribe if you like this content. Hit the bell button so you're notified every time I put out a video. Thank you so much for watching, and have a great rest of your day.